Good evening, you're watching The Big Question. I'm Sanjana. A global giant, 43,000 crores in profit, and India's regulator stepping in to protect the market. On Friday, SEBI cracked down on global trading firm Jane Street, accusing it of manipulating expiry day prices on Nifty and Bank Nifty options to book massive gains. SEBI calls this unlawful profit and has ordered 4,843 crore to be deposited in an escrow account. But Jane Street is hitting back. In a statement to its employees seen by NDTV Profit, the firm has strongly disputed SEBI's findings, saying its trades were entirely legitimate and part of normal arbitrage activity. It also said it's reviewing legal options and maintains confidence in its compliance framework. For Indian markets, this is a watershed moment. Not because a foreign player was caught, but because the regulator acted fast, decisively, and without fear or favor. The message is clear. India welcomes global capital, but not at the cost of market integrity. So how did this trading strategy work? What does it reveal about options and expiry day volatility? And does SEBI's action raise the bar for enforcement across the world? As always, I have an expert panel this evening to decode and explain this entire saga. I have J.N. Gupta, former Executive Director, SEBI, who will break down SEBI's findings and whether the case sets a new precedent for surveillance and enforcement. Uttam Bagri, MD, BCB Brokerage, will explain how expiry day trades play out in the real market and what brokers are observing on ground. And Manishi Raichaudhary, CEO, Emma Capital Partners, will assess how global investors interpret this development and whether SEBI's firm response builds confidence or caution. Let's begin. So let's go into what exactly SEBI uncovered. J.N. Gupta, I'm going to come to you first, sir. What was Jane Street accused of and how were prices allegedly influenced to book profits?
See, my knowledge is limited to what is there in the order or what is appearing in the press. I don't have the deep dive knowledge, but the issue is very simple. Jane Street has tried to time the market, influence the market in such a manner to benefit themselves. And how did they do it? They had a position in index and they knew that what are the heavyweights in the index, and by a contra trade in those heavyweight index things, and knowing that the slight liquidity or slight volume in the index stocks is going to change the value, the index. So that is what they did. They manipulated. I would say that based on the SEBI order, the word manipulation would be the right word. They tried to manipulate one index versus other, and with the contra position, they benefited. So that is how they did. And then very simply, the law very clearly says that there is a prevention of fraudulent and unfair trading practices, which says that any edifice that is used to profit at the cost of others is some sort of a violation of the law. And that is what SEBI has pinned them on.
Uttam Bagri, if you could explain the mechanism. So what kind of expiry day trades can tilt the index even momentarily?
It's very interesting what was done and very obvious, very commonsensical when you understand it. So when you look at derivatives trading, the derivatives prices are typically determined by the cash movement, cash prices. So if you see cash made, the price is 100, you'll assume the price of derivatives will be some function of that. Now, interestingly, this order comes out with some data where the number of participants in the cash market are like 5,000. The number of in the derivatives are 25,000 and number in stock future and in options are 16 lakh people. So what this strategy that seems to be have done is take a very large position in the cash segment. Because you're a rich player, you have the financial muscle, great. There's some strength in the cash market. Take a 5x, 10x, 20x reverse position in the derivative segment in options. All right, your positions are here. Then rapidly unwind your cash segment positions. So when the cash segment prices fall, all your short positions in the derivatives, which is multiple times your cash positions, you end up making a lot of profit. It's It's very simple once you understand it. So buy something in cash, sell it rapidly, and take exactly multiple time position derivatives and then unwind it. You lose 5 rupees here and probably earn 500 there.
Okay. Thanks for really simplifying that. Manishi, is expiry day volatility a known risk globally? And does India's market structure, do you think, make it more vulnerable to that then?
India's market structure, to use a very, kind of layman's term, is honestly, to an outside external observer, it seems ridiculous. Almost 60%, somewhere around 60 to 70% of the global options trading happens in India. And this does not correlate at all with the structure of the options market, or rather the cash market. I would also make the point that, what Jane Street did, it obviously, it does sound like market manipulation, but there are, some arguments to suggest that it could be simple arbitrage trading. Like one of the examples that SEBI has provided, which is from the January 17th early morning trade, 9:15 to 9:22. Right at the beginning of the day, there was a massive difference between the options market implied price of the Bank Nifty and the actual cash market price it was trading at. So, a trader, an arbitrager, a logical arbitrager would obviously buy the asset which is trading cheap and sell the asset which is trading expensive. Classic arbitrage strategy. Now, the problem with this is that, Jane Street did exactly that, but they did in humongous quantity in the cash market, which obviously opens them up for this allegation of pump and dump. I think there will be a lot of, evidence that would come in the future. It's gone to the appellate authorities now, and we will obviously get to know more. As of now, it seems kind of a gray area. There are possibly, arguments in favor of both sides.
I'd like to scratch a little bit more on arbitrage, and I would encourage all of my panelists, Manishi, you said, to put it in layman terms, I'd encourage you more to use it in layman terms, especially for me. You mentioned about the January 17th trade and what Jane Street did that may have perhaps looked like standard arbitrage and not manipulation. Could you explain then in practical terms how global arbitrageurs operate when there are large pricing gaps and why such trades then are considered healthy for markets internationally?
I guess the question is to me.
Yes.
You see, if, from the data that I have seen from the SEBI report, there is, there are some prices quoted there. And if you simply look at what the call option price was implying as far as the cash market price of Bank Nifty was at that time, and what the put option prices were implying, and take some kind of an average of that, a weighted average, you get an implied price of the cash market. But the actual cash market was trading far lower at that point of time. So this is the difference between the actual price and the implied price. And this is what classically the arbitrageurs between derivatives market and cash market do. And, I don't think in any market there's something illegal about it.
Okay.
But, it's, in this particular case and in many other examples that SEBI has cited, there is, and in the event of doing this, there was a humongous quantum of buying in the cash market and unwinding those positions later in the day, which is, that's not usually what an arbitrager would do. So I think there is a bit of a gray area here.
All right. Okay. So let's come for a moment now and shift gears and look at Jane Street's rebuttal that came today. Jane Street says that these were legitimate arbitrage trades and that it will be exploring legal options. Jay Gupta, sir, can arbitrage cross into manipulation, and what's the threshold then SEBI uses to determine intent?
I would say that arbitrage per se is not illegal. Arbitrage is a genuine thing. I would give a very simple example. If tomatoes are selling for 100 rupees kg in Nariman Point and 60 rupees kg in Borivali, you buy from Borivali and sell it in Nariman Point, there is no problem.
Right.
But what happens, these two things are not same class. One is the index option, other is the cash option or cash deal, something like this. Where the index option, the underlying is the cash. So there is a link between the index and the underlying. And what is happening, in order to benefit, you have done cash transaction to manipulate the cash transaction so as to impact the index and benefit yourself. So to me, it very clearly comes under the edifice used for benefiting at the cost of the market integrity. If it was a genuine movement in the cash prices, there is nothing wrong. Here there is intentional movement that I have caused in the cash market so as to impact the index. That makes it a little bit different from a normal arbitrage. See, very simple thing. All regulations are based on one fact, that the market should be a fair, transparent and perfect market. Now, when you look at the classical definition of perfect competition, there are various ingredients. Here, one of the ingredients has been misused by saying that you have tried to influence the cash market to benefit in the index market. That's all.
Got it. Uttam, then from a broker's perspective, how do you identify when large expiry day trades are part of normal hedging or arbitrage versus when they start to look like what Gupta sir is saying, a coordinated attempt to move the index?
So nobody who does a crime says that, hey, I'm guilty.
Yeah.
And every there's this reaction, and no regulator, the police guy who catches you says, hey, you are innocent.
Correct.
So there's an allegation clearly from regulator side ki, hey, I know what trading is. I have access to tons of data and behavior of tons of traders. And I know what arbitrage is. I know what put call parity is. And in fact, the SEBI order says making money is not an illegal thing. Making profits is not a bad thing. But the way you have done it is kind of weird. And it is an obvious rebuttal ki, hey, this was a part of my normal trading strategies. And making 20,000, 25,000 crores profit is just a routine thing that happens to me most of the time. Lovely to hear that. But again, as the basic funda is this, derivatives is a function of cash segment prices. Derivatives prices are a function of cash segment prices. The number of players in the cash segment are much lesser than the number of players in the derivative segment. So there's a natural opportunity out there, mess with the cash segment and make outsized profit in the derivative segment. And it is that is clearly falling in the realms of, if somebody does that on purpose, it forms in the lands in the realm of manipulation. Now it seems the way Jane Street has traded, they have done trades in cash market. It seems are the allegations just for the purpose of making outsized profit in derivatives. Doesn't seem like a normal arbitrage transaction. You were like 25%, 30% of the market. The way you were trading, when in the morning session, the cash segment, you were leading to positive LTPs. In the evening session, there was aggressive selling leading to negative LTPs. You have tons of money to give as margins. You have tons of money to take as stock. This doesn't look like a normal transaction. And if the courts rule and as the arguments go, it turns out that they were actually innocent, it was just normal, fine. But prima facie, given experience, this doesn't look like such a clear-cut case of regulatory overreach. This is a very challenging situation indeed.
Okay, so, you said that these were not normal transactions, but intentional trades in the cash markets to move the index. So,
no, I will say it could be.
It could be. Yes. Okay. So, what specific signs or patterns then would make it clear to anybody or even to brokers that such trades are meant to manipulate rather than hedge or arbitrage?
No, I would need a PhD for that, but I'll still make an attempt. So, and I'm trying to keep it simple. The way the options are priced, all right? There are formulas, there are price options, there are implied volatilities and expected formulas, expected values of all prices.
Yeah.
Typically when a trader tries to trade odd, then you'll see a change in the actual implied volatilities. All right, this is not trading as per vol. That's what I don't want to get into too much details. Even my knowledge is limited. But then usually patterns come out. Second thing that comes is when you see crazy price movements in the cash segment. All right, that gives it, because that will lead to crazy price movements in short period of time in the derivative segment. And finally, the test is, have you been doing this regularly? If this kind of trading pattern is something I'm doing from the last 15 years, or last 5 months, or last 5 weeks, every day this is a strategy I follow, and my trade patterns can show, it is obviously it is just a coincidence. But then on particular days, there's a particular way of trading where then all the regulatory alerts go off. That's what I do in my office myself. For one of the things we do is we have a surveillance for our client trading, and as long as the client is trading normally as he always trades, we are usually more comfortable. It's the odd trading behavior that gets our attention.
Correct. And not just the one-off trade, right? Many odd trades then put together. Okay, let's understand what this means for the Indian markets then. Manishi, is this case, would you say, reassuring for global funds, or would you say it's a cautionary tale?
I think, it means, well, let's first look at what, the Indian regulators, Indian market participants need to do to increase confidence in the market. First, of course, there has to be increased vigilance on the part of the regulator. This has been happening for more than 2 years, I think close to 3 years. It came to light, it came to everyone's attention, not because of anyone who detected it, in the regulator's office, but because of a lawsuit that was filed, against another hedge fund, high-frequency trading fund. Who knows? If that lawsuit hadn't been filed, maybe no one would have noticed it, even now. But at the same time, if you look at that same example, January 17th, the previous evening, HDFC Bank had declared results. They were disappointing, so it was supposed to have depressed the cash market in banks, the bank Nifty in particular. But what happened was a disproportionately strong movement in the bank stocks, in the bank Nifty the next day. That should have been a red flag, but it wasn't highlighted. Well, the whole thing unraveled after the lawsuit in, I think, April 2024. So that's point number one, stronger vigilance on the part of the regulator. Second, investor education. More than 90% of the Indian retail option traders make losses. This is a zero-sum game, but they still keep trading it, and they get butchered. They get slaughtered by the sophisticated, humongously large traders who have sophisticated algorithms, amazingly powerful trading infrastructure at their disposal. So I think a lot of investor education has yet to happen in the Indian market.
All right. Okay. So given that, what you're saying, Manishi, that HDFC Bank's results were announced the previous evening, do you think that the sharp movement that we saw the next day was a rational market response, or did it appear exaggerated compared to historical reactions to similar news?
Well, it did appear exaggerated, no doubt. And that's what I'm saying. That should have been a red flag.
Okay. So, J.N. Gupta, sir, is this then a turning point in how SEBI regulates high-frequency trades and expiry strategies, would you say?
Yeah, I would say that every mishap in the market is a learning lesson for everybody, an opportunity to take corrective action.
Sure.
If somebody says that SEBI should take all the corrective action today and there should be no problem in the future, it will be a foolish expectation, because money is such that it drives innovation. Sometimes innovation in the positive side, sometimes innovation in the negative side. So nothing is going to happen to high frequency trade. It will continue. People will become smarter. The people who want to cheat will become much more smarter. The regulator will have to follow up. But this cat and mouse game will continue. But long term, there is not going to be any change in the market in the sense that you will say that all the liquidity will dry in the options and futures market. No, it is not going to happen, because there will always be two types of people. One who wants to cheat the market, one who wants to continue to participate in the market. So this battle will be never ending battle.
Okay, so then in that case, Uttam, what role can brokers play in flagging such kind of unusual behavior? Is there a pattern that others should be learning from?
It's actually my job as a broker. If
Yeah.
any of the clients are trading in a particular pattern, I need to flag it to the authorities, the front level regulators, which we are supposed to do. Having said that, there's one point I need to highlight. This is a very interesting line in this order, where in February, the SEBI asked the exchanges to actually write to Jane Street and issue a caution letter. Ki, boss, you are a great player, you are a large player, nice to have in the market, love your trading, but I think you're trading silly. In my opinion, please stop, please desist, please, this is not proper. That was actually a very mature thing. I've never heard of the regulator behaving in such a manner. And in spite of that, when they saw it, this guy is not changing, and so they went for this action. This was actually a surprise for me, and I love that approach that SEBI followed. Having said that, as brokers, I need to, all of us brokers need to keep our eyes open, and that we will do.
So if I were to ask you, give me your sense of what reforms might this trigger, whether it's real-time surveillance, whether it's new expiry day rules, limits on index weight manipulation, what would you say?
See, if there's a rampant problem in the market, you need to go after it. But you cannot make policies to handle exceptions. So the challenge for regulators, or actually they have the data to see, hey, is it a couple of people who are behaving in this fashion, or it is just a rampant issue? And if it is exception, then it doesn't require a strong regulatory policy response. As far as surveillance is concerned, that you have to do, that you always have to do. Surveillance, supervision is something that's a basic need 24/7 all the time. It is not a function of an event happening or not. But so far, it seems that from my market sources, there's only one gentleman, one firm which got a caution letter, and not more than one. And it doesn't seem to be a rampant concern issue from the regulatory point of view. But then let's see what the future holds for us.
Absolutely. Let's see. Manishi, considering that some forms of market manipulation, particularly, I would say, in this case, that are easier to detect, like a pump and dump, and others are much harder, like a spoofing or a layering, what should be then the priority for investor protection in India?
Well, I think most of these mechanisms, along with the regulator and the exchanges, they're already in place. It's not that something additional needs to be done. It's only, possibly, making the people who are actually in charge of vigilance, making them more aware, stronger training, etc. But, at the same time, I think some of these more blatant instances, which has been happening over 3 years, perhaps could have been detected earlier. And it's kind of a coincidence in a sense, if I may use that phrase, that it's been detected because of the lawsuit that was filed. I think strengthening vigilance would obviously be a degree of assurance to the retail investor. Coming back to your original question, does it reduce confidence on the part of the international investors in the Indian market? I clearly don't see such possibility. This has happened, no doubt. In fact, much worse instances have happened in other markets, including more developed markets. And even in conversations with the institutional investors that we have regularly, I think this is being treated as an aberration. It's a bug, not a feature, to use technological language.
Okay, so J.N. Gupta, and I'm out of time, so I'm afraid this is going to be the last question. What would you say is the takeaway from this entire case, whether it's from a retail investor standpoint or for foreign institutions?
See, the takeaway is very simple. For retail investors, you do not have wherewithal of the institutional investors' knowledge or vision, something. So do invest in options futures at your own peril and only when you understand it well. That is one. For institutional investors, keep your eyes and ears open, and if you smell anything like Jane Street happening on the street, please go to SEBI and say that you smell a rat. So that will be a better thing than doing anything. But I wish that everything continues the way it has been continuing. The aberrations will keep on happening. Let us not be derailed by that.
Okay, thank you so much to all of my panelists that have joined me this evening and for breaking down what appears to be a complex case, but Uttam rightly saying that it's actually quite simple. So thank you so much for simplifying that. This case is obviously more than a number, and a whopping number at that. It's about how markets are shaped, how trust is built, and how power is held accountable. SEBI says this was manipulation. Jane Street says it wasn't. That legal battle will play out. But what's clear is this: India's markets are no longer a playground for unchecked strategies, whether domestic or global. Surveillance is sharper, enforcement is faster, and the rules are the same for all. That's what builds credibility, and that's what builds India's capital markets. And that's the big message on The Big Question tonight. Thanks for watching.